If you are looking to build, buy, or refinance a multi-unit rental property in Canada, this one program you absolutely need to understand through and through. It is CMHC's standard rental housing mortgage loan insurance. Unlike MLI Select, which is a flashy high score unlock 50-year amortization program, the standard rental housing is a reliable workhorse. It is the program that keeps the rental housing projects moving, even when interest rates or lender requirements get in the way. So today, I am going to break down exactly how this program works, when it should be used, and what CMHC actually looks for before they insure your project or your property. And I'm going to do it in plain English. So let's start with what this program is designed for. CMHC's standard rental housing insurance is for multi-unit buildings with at least 5 or more rental units. These must be standard, self-contained rental units, not retirement homes, not supportive housing, not student residences. This program is specifically for traditional rental housing. And this program can be used for 3 main purposes: construction financing, purchasing an existing building, or refinancing an existing mortgage. So no matter where you are in the project, from building it to buying it, it's to fine-tuning the finances, this program might apply. Now, there is some flexibility for mixed-use buildings, but there are limits. The non-residential portion, like a retail or commercial space, can't exceed 30% of the total floor area or lending value. And any mortgage related to commercial space is capped at 75% of the value, so a 75% LTV. Your building can have stores, but it still must be primarily residential. Now, let's talk about the loan to value ratios, because this is one of the biggest reasons investors use CMHC's insurance. CMHC can go up to 85% of the lending value, 85% LTV, or 100% of the cost, whichever is lower. So when you're purchasing a property, the maximum is 85% loan to value. And when you're refinancing, again, you can go up to 85% loan to value. Now, if you're buying or refinancing with improvements, CMHC can base the loan on the as approved value, which is extremely helpful for value add investors. It lets you borrow against the final upgraded property value, not just what it looks like today. So it's great for flippers. Construction loans under this program come with specific rules though. During construction, CMHC allows advances up to 75% of the cost or lending value. Anything above that value requires a rental achievement, meaning the building must reach projected rent levels before the funds are released. They can also require a quantity surveyor to review the construction costs, unless you're in a small market where there can be some flexibility. CMHC also requires a fixed price construction contract or a construction management setup. And CMHC must approve the first and last advances. Everything in between those two is managed by the lender. If you're making improvements to an existing building, the rules depend on whether the tenants stay during the renovations. If rental income continues, CMHC allows advances based on the greater of 75% of the as approved value or 85% of the as is value. If rental income stops, the maximum is 75% of the as improved value, and rental achievement applies again. Now, let's talk about debt coverage ratios. This is usually the first place a lender says yes or no. For buildings with 5 or 6 units, let's say, the minimum DCR is 1.10. For purchases, it's 1.20 for refinances. For buildings with 7 or more units, the requirement is 1.20 for mortgage terms of 10 years or more, and 1.30 for terms 10 years or less. For non-residential portions, the minimum DCR increases to 1.40 or 1.50. Now, CMHC also allows both fixed and floating interest rates, but the floating interest rates must have a ceiling to limit risk. Amortizations can go up to 40 years for existing properties and up to 50 years for brand new, as long as the building's remaining economic life supports it. Amortization above 25 years does come with a premium surcharge. In terms of security, CMHC allows first mortgages, second mortgages, and even pari passu, meaning two lenders sharing the same security. Second mortgages are permitted as an interim measure, which helps when structuring complex construction financing. But let's talk about borrower eligibility, because you obviously have to be eligible for these programs. CMHC wants to see competence and experience. They require at least 5 years of management experience with similar multi-unit buildings. If you don't have that experience personally, you must bring in a professional property management company. The borrower must also have a net worth equal to at least 25% of the loan amount with a minimum of $100,000. This ensures you have the financial capacity to handle issues that might arise during construction or operation. Let's move to guarantee requirements. For construction financing, the borrower and guarantor must guarantee 100% of the loan amount until the building reach stabilized rents for 12 consecutive months. After stabilization, the guarantee can be reduced to 40%. For purchases or refinances, the standard guarantee is 40% of the outstanding loan amount. Limited resources may be available when the loan does not exceed 65% of the lending value. In those cases, the lender's resources is limited to the property itself and any assets taken as security, not the borrower personally. CMHC may still require added risk mitigation tools such as replacement reserves, additional collateral, or personal guarantees depending on the situation. In the end, CMHC's standard housing program gives borrowers access to preferred rates, better loan terms, smoother renewals over the life of the mortgage. It is ideal for investors and developers who want traditional financing without committing to affordability or energy efficiency targets like the MLI Select requires. So that's the full breakdown of the CMHC standard rental housing program. It may not be as flashy as the MLI Select, but it's one of the most important tools for building, buying, and refinancing multi-unit rental properties in Canada. Now, if you want me to compare this program directly to MLI Select or help you figure out which option makes sense for your next project, click a link below and book a call with me. And if you found this helpful, please don't forget to like, comment, and subscribe, and stay tuned for more Canadian real estate and mortgage updates.